This is an analysis from Alpha Business Media.
Imagine for a second that the ground beneath your feet just shifted. Not because of an earthquake, not a landslide, I mean, we know those all too well here, but because of a handshake. A quiet, digital handshake that most of the world didn't even see happen.
And just to be clear, this wasn't a handshake in, the Rose Garden or at 10 Downing Street. This happened in the cloud on January 1st, 2026.
We are talking, of course, about the launch of the BRICS Bridge pilot. Now, to the casual observer, that sounds like I don't know, a construction project or maybe a new card game.
Right.
But the shockwaves it sent out were purely financial, and they were massive.
Massive is probably an understatement. This wasn't a bridge of steel and concrete. It was a financial bridge, a kind of digital ledger system that let the expanded BRICS bloc settle trade without ever touching the U.S. dollar.
And we should stress expanded bloc because it now includes heavyweights like Saudi Arabia, the UAE, and Iran. And the immediate fallout from this, a $2 trillion sell-off in the U.S. Treasury market. Now, I know what some of you are thinking. Okay, so Wall Street is having a panic attack. Traders in New York are sweating.
Why should I care?
Why should I, sitting in Kathmandu or Pokhara or Biratnagar, care about bond yields in America?
It's a completely fair question.
Yeah.
It's so easy to dismiss this as some high-level casino capitalism that stays in its ivory tower.
But the mission of this deep dive is to, well, shatter that illusion.
It's not just an illusion.
Because this isn't just about hedge funds in Connecticut. We are going to unpack exactly what this means for Nepal. We're going to trace that invisible line from that digital handshake all the way to a CEO in Balowatar trying to get a loan, or an importer in Burgunj buying fuel.
And even a family in Gorkha just waiting for a remittance transfer.
Right.
The headline here is simple, even if the mechanics are complex. The era of, let's call it passive reliance on the U.S. dollar, it's over. And for Nepal, understanding this isn't some academic exercise anymore. It's literally a matter of national economic survival.
So let's get into the gears of this machine. We have this huge event on January 1st, but to really get why it matters, I feel like we need to look backward first. You mentioned the petrodollar. That's a term we hear thrown around constantly on the news. What exactly was the system before this handshake blew it up?
It's a fascinating bit of history that basically defined the global economy for the last 50 years. If you go back to the 1970s, there was this tacit kind of unwritten agreement. OPEC nations, led by Saudi Arabia, agreed to price their oil exclusively in U.S. dollars.
So if you were Japan or Germany or even Nepal and you needed oil, you had to get dollars first.
Precisely. It created this permanent sort of artificial demand for the dollar globally. Everyone needed them to keep the lights on. But here's the second part of the cycle, which is, arguably even more important.
Okay.
Those oil exporting nations were just swimming in dollar revenues. What did they do with them? They couldn't just stuff them under a mattress. They recycled them back into the U.S. economy by buying U.S. Treasury bonds.
So it was a symbiotic relationship. The world buys oil nations get the dollars, and then they lend those same dollars right back to the U.S. government, which keeps interest rates low.
And that system kept the dollar stable and American borrowing costs cheap. It allowed the U.S. to run these massive deficits because there was always a buyer for their debt.
Until January 1st, 2026.
That's when the BRICS Bridge pilot broke that cycle.
This is where the details get really interesting. We saw Saudi Aramco settle a massive oil shipment to China's Sinopec, but they didn't use dollars.
No dollars and no SWIFT messaging system, which is, the Western controlled network for all international transfers. They used digital yuan cleared over this new BRICS platform.
And it wasn't a one-off.
Not at all. We saw Indian refiners paying the UAE in digital rupees, Russia settling with Brazil in rubles. The floodgates kind of opened.
So the monopoly is broken. The petrodollar isn't dead, maybe, but it's definitely on life support. But help us connect the dots here. Why does countries trading in their own currencies lead to a sell-off in the U.S.?
Just think about the incentives. If Saudi Arabia or the UAE no longer need these huge piles of dollars to do their daily trade, then they no longer need to hold massive reserves of dollars.
Okay, that makes sense.
And if they aren't holding the dollars, they don't need to park those dollars in U.S. Treasuries anymore.
The demand just evaporates.
Right. The whole incentive to hold that American debt just vanishes. And that's where that $2 trillion number comes from. It's not just that they stopped buying new debt. Central banks across the BRICS plus bloc started actively selling what they already had.
They call it rebalancing, but to the market, it just looks like a fire sale.
Exactly. And when you dump that much supply onto the market, the price crashes. It's just basic supply and demand.
Which is where we get into the mechanics of the panic.
Yes. But here's where we need to be careful with our terms. When we say crash, people usually think of the stock market plunging. But we're talking about the bond market. And the mechanics there are a little different and, frankly, more dangerous for the real economy.
Right, let's unpack that. In the bond market, prices and yields are like a seesaw. They're inverses.
Correct. When everyone is selling bonds, the price of that bond goes down. But the yield, that's the interest rate the government has to pay to attract buyers, goes up. Because if nobody wants your debt, you have to offer a better return to sell it.
So because the BRICS nations are dumping these bonds, the U.S. government suddenly has to offer much higher returns to get anyone else to buy them.
Precisely. And the numbers here are staggering. In just 1 month, the yield on the U.S. 10-year Treasury jumped from a stable, 3.5% to over 5.5%.
5 percentage points. That might not sound like a lot to a layperson. I mean, if the price of milk goes up 2%, nobody really notices.
In the financial world, a 200 basis point move, that's 2%, in a month, is, well, it's seismic. It's like an earthquake. It completely changes the calculus for every single other loan on the entire planet. And it has led to something economists call an inverted yield curve.
I've heard that term. That's the big recession predictor, right?
It is the most reliable recession predictor we have. I mean, historically, you should get paid more interest for lending money for 10 years than for 2 years, correct?
Yeah, of course. It's a bigger commitment, more risk over time. I'm locking my money away for longer, so you should pay me more.
But right now, short-term yields are higher than long-term ones. That inversion means investors are just terrified of the near future. They're demanding huge compensation for short-term risk. The market is screaming that something is broken in the plumbing of the global economy.
So all the dashboard lights are flashing bright red. Now, let's bring this home. I can literally hear the listener in Kathmandu asking, okay, interest rates in America are up. Why does that hurt a dam project in Nepal? We pay in rupees, don't we?
That is the multi-billion-dollar question. And here's the reality. The U.S. 10-year Treasury isn't just an American rate. It is the global benchmark. It's what's called the risk-free rate, against which almost every major infrastructural project in the world is priced.
So if the foundation gets more expensive, the whole house gets more expensive.
So let's take the Budi Gandaki hydropower project.
Yeah.
A massive, massive infrastructure ambition for Nepal. When international lenders look at financing that, whether it's the World Bank, the ADB, private equity, they start their math with the U.S. 10-year rate.
That's the baseline.
Then they add a risk premium for Nepal. They say, okay, U.S. debt pays 5.5%. Nepal is riskier, so we need 5.5% plus another, say, 4 or 5%.
So if the U.S. rate jumps by 2%, our cost for that project jumps by 2% automatically.
Before a single rupee of local risk is even calculated, a 200 basis point rise can make a project like Budi Gandaki suddenly unbankable. The financing costs, the interest payments alone, they just eat up any projected returns. You literally cannot afford to build it anymore.
Wow. It's incredible how fragile that math is. And the source material brought up Bhutan as a comparison here. They seem to be weathering this a bit differently.
Bhutan is in a slightly different boat, yes. Their hydro projects are largely financed through bilateral agreements with India, often using a cost-plus model or government-to-government financing that uses different benchmarks. They are partially insulated from the global dollar market.
Whereas Nepal relies more on a mix of international financing, which leaves us really exposed to these global shocks.
It really highlights the vulnerability in how we diversify or, fail to diversify our financing sources. We are essentially importing American inflation and American risk right into our national projects.
And it's not just building new dams, is it? There's an immediate energy security risk, too.
Oh, absolutely.
Right, this is where the rubber meets the road for the Nepal Oil Corporation, the NOC. We import something like $3 billion worth of fuel annually, mostly paying the Indian Oil Corporation, or IOC. And historically, that bill is settled in dollars.
Or at least the pricing mechanism is dollar-based. But now, look at the geopolitics. India is a key player in this BRICS plus shift. They are championing de-dollarization. They are pushing for trade in local currencies.
So it's not a stretch to imagine a conversation between the IOC and the NOC pretty soon.
It's a matter of when, not if, the Indian Oil Corporation asks or tells the NOC to settle that bill in Indian rupees instead of dollars.
On the surface, that almost sounds convenient. I mean, our currency is pegged to theirs. Why is that a problem?
It sounds convenient until you look at the balance sheet of the Nepal Rashtra Bank. Our reserves are heavily weighted towards convertible currencies like the dollar. We hold dollars to pay for things.
I see.
If you suddenly need billions of Indian rupees to pay for fuel, but all your trade financing and reserves are built around the dollar, you have a massive mismatch.
You'd have to sell dollars to buy rupees, probably at a time when the dollar's really volatile.
Exactly. It forces a complete overhaul of the Nepal Rashtra Bank's currency management strategy. It exposes the entire economy to new exchange rate risks we aren't quite ready for. We simply don't have the liquidity in rupees to handle that kind of volume overnight. It's an operational nightmare waiting to happen.
Let's shift gears from the macro, the dams, the oil corporations, to the micro, to the individual, because the sources mention a fear gauge, the VIX index.
The VIX, yeah. It measures volatility in the stock market. So here's the chain reaction. Because safe government bonds are now paying 5.5%, which is a guaranteed return backed by the U.S. government, investors are pulling money out of risky things like stocks.
Why gamble on Apple or General Motors when you can get a guaranteed 5.5% from Uncle Sam?
You wouldn't. So money flees the stock market, causing a crash there too. And this triggers a domino effect in the real economy. High borrowing costs hurt companies like GM or Apple. They have to pay more on their debt, so their profits shrink. And when profits shrink, they cut costs.
And cutting costs is just corporate speak for layoffs. And this is where the recession fears come in, if the West goes into recession.
Or, and this is so critical for us, if the Gulf economies slow down because their own project financing costs are going up.
Then Nepal is in serious trouble.
We are a $10 billion remittance economy. That is our lifeline. Over 40% of that comes from the Middle East and Malaysia. A growing chunk comes from the U.S. and Europe.
So walk us through that scenario. A Nepali worker in Qatar is working for a construction firm. That firm's financing costs just doubled because global rates spiked.
That project might get canceled, that worker might get sent home, or at the very least, their hours get cut. The danger here isn't just that remittances will drop, but that they'll become unpredictable.
The source material really emphasized that word, volatility.
Yes, because think about it at the household level. If remittance inflows drop by even 10%, that's a loss equivalent to 1.5% of our entire GDP. But the volatility makes it impossible for people to plan. If a family in Gorkha doesn't know if the money is coming next month, what do?
Their consumption just stops. They stop building that house. They stop buying consumer goods. They hoard cash.
Exactly. They go into survival mode.
Yeah.
And when they stop spending, the local shopkeeper loses business. The whole local economy just freezes. It's a behavioral recession just as much as a financial one.
And speaking of freezing, it sounds like the local banks in Nepal are freezing up too. The analysis mentioned mark-to-market losses. Can you explain that in plain English?
Sure, Nepali banks hold foreign bonds, U.S. Treasuries, European bonds, as part of their safe assets. It's where they park their money. But remember that seesaw we talked about? The price of those bonds has crashed.
So even though the bank hasn't actually sold them, they're worth a lot less on paper today than they were yesterday.
Right, and accounting rules say they have to report that loss on their balance sheet. It's a paper loss, but it makes their capital look much, much smaller.
So the bank manager looks at the books, sees the capital shrinking, and gets scared.
They get conservative, very conservative. They stop lending. Even if a business in Kathmandu is healthy, profitable, and ready to expand, the bank might just say, sorry, we're freezing credit right now. We need to shore up our own defenses. It's a credit crunch imported directly from the U.S. Treasury market.
It's terrifying how connected this all is. You pull a thread in the bricks block, and a bank in Kathmandu stops lending to a local bakery. This leads us to the big geopolitical dilemma. The sources call it the elephant in the room, or maybe the dragon and the elephant in the room.
This is the core headache for the Nepal Rashtra Bank, the NRB. For decades, we've had a very simple anchor. The Nepali rupee is pegged to the Indian rupee. And the Indian rupee was, for all intents and purposes, anchored to the stability of the U.S. dollar global system.
A nice, stable chain. A leads to B leads to C.
But that chain is breaking. India is actively moving away from the dollar. The dollar itself is becoming volatile. And the NRB is just stuck in the middle.
The sources outline two scenarios here. One is a little more optimistic, or at least manageable. They call it managed fragmentation. What does that look like?
In that scenario, the West steps in to stabilize things. Maybe the Federal Reserve calms the bond market. The shift away from the dollar continues, but it's slow, it's, orderly, And it gives Nepal time,
Time to do what?
time to diversify, to slowly buy gold, buy yuan, buy euros, to set up trade agreements with India and China in local currencies, basically to reinforce the house before the storm gets any worse.
But then there's the second scenario, accelerated geoeconomic conflict. That sounds bad.
This is the nightmare scenario. Imagine the U.S. decides to fight back against this BRICS move. They implement sanctions, trade wars, they weaponize the dollar to punish countries moving away from it.
Ah.
In that world, Nepal gets caught in what the analysis calls a geostrategic vice.
Because if we start holding Chinese yuan to pay for things from China, the U.S. might look at us and say, hey, whose side are you on?
Exactly. Holding yuan could invite U.S. scrutiny or even secondary sanctions. But sticking to the dollar, when India and China, our actual neighbors and biggest trade partners, are abandoning it, would be economic suicide. We'd be using a currency that nobody we trade with wants to use.
It feels like we are stuck between a rock and a hard place. Or, as the source puts it, stuck between an increasingly volatile dollar, an independent-minded Indian rupee, and an assertive Chinese yuan.
It's a tripartite risk. And the hard truth, as outlined in our analysis, is that the stability we enjoyed for so long was a temporary privilege of a unipolar world. And that world is gone. We can't wish it back.
So what do? We can't just sit around and hope the Federal Reserve fixes everything. The analysis calls for operational mechanics. What does that even mean in practice?
It means we have to get our hands dirty with the plumbing of finance. We can't just talk about diversification in speeches. We have to build the systems. The sources suggest regulatory sandboxes.
Break that down for us. What is a regulatory sandbox in this context?
Essentially, it's a safe space created by the central bank where businesses can experiment. The NRB would say, okay, for these specific exporters, go ahead and try invoicing in Indian rupees or Chinese yuan. We'll waive certain regulations for you just to see if it works.
So we let the private sector figure out the mechanics of trading without the dollar, without drowning them in red tape.
Exactly. We need to let importers and exporters figure out how to trade in these currencies efficiently. And technology plays a huge role here too.
The digital handshake we started with.
Right. We need the capacity for cross-border digital settlements. If the BRICS bridge is digital, Nepal needs to be able to plug into it, or at the very least, plug into the Indian and Chinese versions of it. We can't be using fax machines when the rest of the world is using blockchain.
It really sounds like we need to stop being passive observers in all this.
We have to. The Ministry of Finance and the NRB need to be wargaming this right now. We need economic diplomacy that ensures we aren't forced into some binary choice, U.S. or China. We need to carve out a space where we can trade with everyone.
It's a sobering realization. We started this deep dive talking about a digital handshake, and we've ended up realizing that the entire operating system of the Nepali economy needs an upgrade.
It does. The old playbook doesn't work when the rules of the game have completely changed.
So here's the thought we want to leave you with today. For 50 years, the most important question for any Nepali business person, whether you were importing cars or exporting carpets, was, what is the dollar doing?
It was the only question that mattered. It determined your profit, your loss, your entire strategy.
But maybe, just maybe, you need to stop asking that. Maybe the question you need to start asking yourself, whether you're in banking, trade, or just trying to save for the future, is no longer what is the dollar doing, but who are we actually trading with?
Because in this new world, the currency of your partner matters more than the currency of the reserve.
A massive shift in perspective, and one that requires us to pay a lot more attention to the plumbing of finance, not just the headlines. Thanks for unpacking it all with us. This has been The Deep Dive.
Thanks for listening.